Hey, David, that's right. It's not just a racism issue, but a fiduciary duty one as well. Asset allocators think endowments, sovereign wealth, and pension funds may be missing out on returns by undervaluing high performing Black fund managers and overvaluing those led by white men. That bias was discovered through that study you mentioned by Stanford University and Illumen Capital. Now, the researchers asked the allocators to evaluate managers based on returns, exits, and credentials, and they found that at the highest levels, allocators tended to give Black managers lower performance ratings than white managers of similar quality. But then among the weaker teams, the allocators were actually prone to favoring Black managers. But it's unlikely that they'd actually invest in a weaker fund regardless of race. The researchers say that the results of their study suggest that in addition to racial disparities in the pipeline for fund managers, there exists, quote, systemic racial disparities in how investors evaluate funds and allocate money.
When I hear arguments around diversity or excellence, paying attention to manager diversity or performance, that actually flies in the face of that and lets us all know there's something else at play. This is not about performance. This is about something else. And unfortunately, that something else is racism.
There's a long way to go to close the gap here. Currently, of the $69 trillion in hedge funds, mutual funds, real estate, and private equity across the globe, just over 1% is managed by women and people of color. David.
Leslie, stick with us for now. I want to bring in our next guest who was part of that study as well, Darren Dodson, Managing Director at Illumen Capital, who joins us now. Good to have you this morning, Darren.
Wonderful.
Give me some sense as to your reaction to the study and what you've seen, frankly, from your own work as well.
So as a managing director of Illumen Capital, we're a private equity venture capital and growth fund of funds. And we work on applying evidence-based research to reduce implicit bias and unlock returns. So I think the big question that we ask is, over the last 30 years of emerging manager programs that have been touted as one of the ways that the industry can succeed, and including women and people of color managers, particularly Black managers, essentially we're at 1.3%, which is a dismal failure. So part of what we ask is, well, what's happening that is preventing this number from moving? It's over 52 years since Dr. King was killed, and for tying together these disparate pieces of economic justice and economic optimality. And people are willing, essentially, because of their biases, as our thesis points out, to accept lower returns due to their unconscious bias. So that's the key. And if we can reduce that, if we can make that a part of processes, then we can unlock returns.
Right. I mean, you would assume that they want to generate as high a return as they can. So how do you make them conscious, I guess, of their bias if, in fact, they're unconsciously making these decisions based on race?
The first thing we do is prove, as we did in the paper in collaboration with a lot of the leading Stanford professors in the world on implicit bias, social psychology, and portfolio allocation. We look at those strategies, and then we really dig in to helping them understand that we use measurement in every field of finance. It's not new. We know what a normal curve is. We know what we should be looking at in terms of the most talented people in the world. We're about underweighted $35 trillion in capital relative to what we'd expect by representation of women and people of color within the most talented asset allocation portfolios. And we help them to realize that if they aren't operating from that standpoint of proactively looking at that audience of top performing managers, then they've really kind of missed the boat. Typically, over the last 20 years, people have thought that this is a pipeline problem. And there are issues with the pipeline. However, what we proved is, even if you solve the pipeline problem, systematic bias at the asset allocation level will lead to suboptimal returns. We'll consistently overlook and underestimate the top performing managers, which is, as was mentioned before, kind of a big stain on people's desire to achieve their fiduciary duty for their university endowments, indeed for their foundations, endowments, and indeed for sovereign wealth funds and pension funds.
Darren, in the finance industry, have you personally experienced this bias firsthand?
I pitched 500 times over the last couple of years, and yeah, experience it every day.
And you're also, in addition to being, in charge of a fund of funds, you're on the board of Ben and Jerry's, which made a lot of news for putting out a long and pointed statement around the issue of white supremacy, around the issue of social justice and the protests that we're seeing. What do you see as the responsibility of corporate America in this issue, especially as it relates to some of the key things that the protesters are calling for?
Yes, and as we look at Ben and Jerry's statement, the independent board of directors, of which I'm a part of, is a unique creature under the Unilever umbrella. So part of what we are responsible for is executing on the social, economic, and quality missions of the company. And that's an incredibly important role to align around what we're going to do to rise to meet the call of our values around racial equity and justice. And we're currently in that process as a board of setting lots of parameters and targets in collaboration with the management team in order to rout out structural racism and white supremacy within the company itself. And that's not a journey we began yesterday or 3 weeks ago. It's a journey that 4 years ago, the company was publicly in support of Black Lives Matter. And even before that has done a lot of things since its founding to continue this movement and be supportive of those on the front lines, really taking on these issues of white supremacy across the entire business and communities in which we operate. We're in 35 plus countries around the world. This is not simply a US problem. And it needs not only protests, but it also needs proactively building towards a better and united world that includes having things like Black suppliers, for supplier diversity, and systematically thinking across every aspect of a company's spend, growth, board, senior leadership team, et cetera, how we really route out these issues that prevent the outperformance of the company and overlook the humanity of so many people and human beings that are women and people of color throughout the global financial markets.
Darren, on the manager selection issue.
Welcome to the webinar. Please stand by. The webinar will begin shortly. Please remain on the line.
Incentives to look at diversity of managers as part of their selection process. Are those programs just not effective or not pervasive enough? Are they part of the solution?
The broadcast is now starting.
So one of the things that we have in asset management is something called a sleeve, where there's a partial thing that sometimes allows a little bit of capital to flow. And what we focus on at Illumen Capital is the main spigot, not the tributary of the river, but the main river. And the main river is at 1.3%. After people have made lots of efforts over the last 30 years and even before that to kind of try to solve this problem. So something is fundamentally broken in that number stays so low when we'd expect the brilliance within the optimal portfolio to be closer to 50% or higher based on the brilliance we know is present in the society. And like I said, many will argue there's a pipeline issue, but the issue we see is a Black high-performing manager right in front of the face of an asset allocator will not get a fair shake, and the higher they perform, the less likely they are to be invested in.
Hey, Darren, finally, you'd mentioned you've pitched, I think, 500 times, and you said you experience racism, I guess, in some way, you feel almost every day in that sense. I mean, when you follow up, when you've not gotten a mandate, what is the typical answer you get then when you ask why?
Oh, so one of the common misconceptions of our strategy is people will ask us to train them in implicit bias reduction because they hear our thesis and they know that it might lead to outperformance. But we're not a training firm, we're an asset management firm. And the way to be a part of the journey of understanding one's bias is to commit, like our fund managers do, to 10 years of work. And we work quarterly over a 10-year process with our fund managers to undo the processes that all of us have around implicit bias as we take on the challenges that we seek when we seek to create alpha generating returns. So for those that love alpha generation, I think they kind of get it sometimes, but a common misconception is that they could train, which many people have done over many years, in ways that are not kind of evidence-based and think that they're finished without moving their assets. So the scoreboard is 1.3% moving to 50%, and you can't get there just by training, you have to move assets.
Understood. Well, Darren, appreciate you taking some time with us this morning. Darren Dodson, thank you as well to Leslie Picker.